Vasu, the images we're getting from the vicinity of the nuclear power plant in the Ukraine are deeply troubling and disturbing. What are you telling clients who are waking up to this situation this morning?
Well, political events are unfolding, Yousef. And this may not be the end. There could be more political twists and turns in the coming days and perhaps even weeks. The biggest risk is the unknown. We're not sure what we're dealing with. Things are still unfolding. But if you look at history, typically geopolitical events like this cause a big sell-off in the markets initially, and then you see a rebound subsequently, as long as you don't have a big economic shock. So our base case is that this will be contained within Ukraine. There will be some economic shock, but not enough to derail the long-term trend for equity markets. So we are actually medium-term positive in the equity markets. For clients who are looking to buy, what we're telling them to do is to buy gradually and not go headlong into the markets, not to try and time the markets. Value is starting to emerge. And I think there is a case for some investments, but not to be too aggressive at this juncture, because the political twists and turns are still playing out.
Yeah, Citi would tend to agree with you. They're saying basically this is a good time to raise stock exposure, tech back to overweight in particular. But I look at what's happening and I see a nuclear power plant getting involved, beginning to wonder, there's not a lot of historical precedent for this. Are you building up some defensive hedges then in the portfolio? Are you loading up on a little bit of gold or telling clients to do that, perhaps even in tandem with picking up selectively some risk assets as well?
Definitely, Yousef. We're not suggesting that investors buy completely stocks, allocate completely to stocks. We think that a balanced, diversified approach still makes sense. We are more positive on equities compared to bonds, but we're not saying avoid bonds altogether. So investors should have some kind of a balance. They can have more stocks in their portfolio, but they should have some bonds as well, and gold too. Gold has done very well. But in the medium term, if this crisis cools off, interest rates hit higher, that may not be the best piece of news for gold. So our forecast for gold over the next 12 months is that gold could possibly ease towards $1,700 an ounce from the current levels. In the short term, gold prices will stay elevated, may even hit a bit higher. But I'm not sure whether it's a medium-term hedge. So we are still sanguine on the outlook, and we still think that equities are still the main way to go. Although I think investors should, for prudence, have a diversified portfolio.
Let me run this by you, because you look at some of the signals coming out of credit, you look at the signals coming out of energy. Every time we had price moves of this magnitude in the energy markets over the last 50 to 60 years, what came after was a recession. Is that what investors need to start calibrating for?
I think at this juncture, the base case is not a recession. We are looking at global economic growth of about 4.6% in 2022. We've taken it down slightly in view of the situation in Ukraine. But of course, we are assessing the situation in Ukraine. If it's prolonged and commodity prices stay elevated for a long period of time, then we may have to shape our economic growth forecast even further. But 4.6%, even 4.3% perhaps, is still a very high number compared to historical world growth of 3 to 3.5%. So we're not in the camp where we see a recession. We still remain relatively sanguine about economic growth. We are hopeful, and we think it's possible that this will eventually come to pass. And as long as it's contained within Ukraine, if it comes to pass, the crisis comes to end, commodity prices will ease from the peak that we're seeing right now.
One of the top forecasters for China equities is from Morgan Stanley, and the point was being made that if you thought that we've hit the lows, you're in for something else, because on a technical level there could be an implication of downside of an additional 20%. How are you approaching Chinese opportunities at the moment, given the dislocations we're seeing in the rest of the world?
Well, interesting question, Yousef, because we've actually recently upgraded our asset allocation call for Asia ex-Japan from neutral to overweight, and we have taken China up from neutral to overweight as well. So we've turned more positive on the Chinese equity markets, because I think, in the case of China, number one, the government is actually easing policy, fiscal policy, monetary policy is being eased, infrastructure spending is picking up. That's quite counter to what you have elsewhere in the world where tightening is taking place. So China had a very bad year in 2021. We think the economy bottomed in the fourth quarter of last year, and it's probably going to rebound and grow at about 5.7% in the fourth quarter of this year, compared to 4% in the fourth quarter of last year. So we are positive on the Chinese equity markets. Valuations looking interesting, but of course, if there is a nuclear fallout, a nuclear war in Ukraine, let's hope that it doesn't happen. But if that happens, or if there are severe sanctions on the energy sector in Russia, then it's possible that prices could fall significantly from current levels. But that's not our base case scenario.